Hi everybody, welcome to Trading Conversations. You are here, my friend, because you believe that profitable trading is one of the most efficient ways to attain financial freedom and can be achieved as long as you are willing to put in the hard work to develop your trading competency. Our goal with this show is to introduce you to the traders who have dug through the trenches and emerged at the other end. From the sharing of their trading stories, strategies, workflow, and best practices, I hope to help you shorten your learning curve as you embark on your journey towards trading mastery. Today's guest is the President and CEO of CTS Global, one of the largest global equities proprietary trading firms in the Philippines, where he trains and oversees more than 40 proprietary traders for the company. Currently, he's also serving as the board member and mentor at Caylum Trading Institute, one of the biggest and most established premier trading education facilities in the Philippines. Since the age of 16 years old, he has been exposed to stocks and has been trading global markets since then, ranging from the Philippines market to the US market to Hong Kong and Japan equities market. With more than 20 years of trading expertise, I'm sure there are many great trading stories and wisdom that he can share with us in this interview. So please join me to welcome Lawrence Lee. Hey Lawrence, thanks for joining me in this episode of Trading Conversations.
Great to be here. Thanks for inviting me.
Fantastic. Well, it seems to me, I did a bit of research about you prior to this interview, and it seems to me like your entire family is into the business of financial markets trading. For example, with your brother Edmund taking charge at the Caylum Trading Institute, your father, Mr. Edward Lee, being the chairman of COL Financial, while you are running the proprietary trading arm at CTS Global. So just help me understand better, was it the family environment the main reason why you were exposed to the stock market at such a tender age of 16, when most boys your age at that point in time were probably thinking about having fun and chasing after girls? How did it all start for you back then at the age of 16?
Yeah, we're basically built for the business, right? We've been heavily exposed by my dad about the stock market, and it's a very easy environment to really get hooked onto. We were basically started very young. We got exposed. We were still finished. We just finished school. I just finished school back then, and they asked me to go and be on the trading floor and be able to learn from all the commotion that's happening all over there. So unlike today, where we're stuck behind a computer and we're basically participating in the markets online, back then there was no real internet. So most of what was happening is really on the floor itself. You actually exchange all the trades by hand. Everything is done by broker, not online broker. It's physical broker. So you got to make calls and you have to enter orders through other individuals. So it was a pretty great experience for me. Something very different than what you see today.
I see. So was it an occasion where your dad just threw you onto the trading floor and say, Lawrence, I give you this small little amount of money, so just go and figure out how you're going to use this money to turn it into more money? Was that how it all happened?
Actually, it wasn't really about making more money. It's actually just about learning experiences. That's the one thing that my dad's always been giving us the ability to do, is really to make mistakes. He really understands that us really having to grow, the mistakes are going to be part of the process. And in order for us to become better individuals down the road, we have to be able to get all these experiences under our belt. So making money and especially losing money are part of that process, right? So without that, we're never really going to be able to, most individuals don't even allow themselves to lose money, let alone other individuals to let you lose their money, right?
I see. So can you recall your very first trade that you made using real money? How was that experience like for you, and did the trade turn out well for you?
Yeah, it was actually my first month of trading, not the first trade, but the first month of trading, I got very lucky because I was sitting inside the most manipulated stock in Philippine history, right? That stock went from 1 peso to 108 pesos in about 9 months. And I was sitting somewhere in the middle of it, and I just took advantage of the commotion in between. So I basically made $7,000 in my first month of trading. That's a lot of money for a 16, 17-year-old, let alone our age already. So you can imagine how easy it was to get hooked in this industry.
I see. So were you, in a way, starting to get a bit cocky, like what most traders do when they register the very first winning trade without having any losing trades before that?
Yeah, you really don't know what losing feels like. So, firsthand, you're like, this is easy stuff. And when you make that realization that it's easy stuff, you have a problem already. So we call that the Superman effect, right? So this industry is very volatile, and it's very unforgiving. But during those periods where the markets are very forgiving, it seems like any trade you'll just make money, and that's very far from reality, right?
I see. So once you had that first taste of a winning trade, I suppose that you just simply can't stop anymore, right? And you just want to find out what else you can do to try to generate performance on whatever capital that you might have been given, or whatever capital that you might have. So what was your evolution thereafter? Was it really a very smooth journey for you right from the start? And until which point did you start to realize that trading is actually not as simple as it is?
Yeah, so when I finished school in 2003, I came back home in 2004. I hit the ground running and started trading. I actually been part-time trading since 1999 to 2003 when I was in college. But when I came home from the States in 2004, I hit the ground running, and you're basically sitting in one of the largest bull markets during that period, right? So from 04, 05 till all the way to 07, that's about three-year period from 05 to 07. I turned 800,000 pesos into 10 million pesos. So that's more than 12. That's like a 12 bagger during that period, right? What we don't realize is that at the very peak of markets, I basically had 10 million in cash and 5 million pesos in margin, and I put everything into a stock called COL Financial, and I said I was going long term on it already. And then the next 6 months, I turned 10 million into 900,000 pesos, and basically losing everything I made for the past 3 years. So when you think you're in everything can go, nothing can go wrong, and everything's just going to go right, that's when you don't realize that any one mistake can completely wipe you out, right?
I see. So let's just backtrack slightly. For that 3 years that you were making, you made almost 10 times your original capital. Can you shed a bit more light about the kind of strategy or the methodology that you were using at that point in time? I'm sure now that you think back, it is quite a bit of luck of being at the right place at the right time. But I'm sure by then you should be using some kind of strategy already, right? And what kind of strategy was that you were using to generate that kind of returns?
It was really a momentum strategy, just buying high, selling higher. But it was during a period where, if you're in a bull market, no matter as long as you're participating, you're making money. It just so happened that I was very aggressive during that time, since I didn't really understand what losing was. So you're just being aggressive at the right place at the right time with margin. So you're basically trying to get the fastest horse. You couldn't really go wrong during that period. Anything that you're buying was going just continuously going up every single period. And by being able to take advantage of the leverage at the same time, your portfolio really balloons, right? It was just during the peak where you didn't really realize what leverage really meant, and that it's a double-edged sword.
So you were actually constantly just getting in, getting out, getting in, getting out, and every time it just goes higher from there. And right. Did you use margin very liberally at that point in time?
No risk management. You're just guns blazing every single time. So this is how you realize that in a bull market, anybody can be good. Any trader can think that they're good during that period. What you don't realize is that the great traders, the real pros, are the ones that are good regardless of the market environment, right? And that's what separates the pros from the amateurs and the retail traders.
I see. And you mentioned that you made more than 10 times your returns during that 3 years. And after that, you decided that you just want to go into a long-term investment. What was the transition? What actually happened that caused you to stop wanting to continue with this momentum strategy that you are using and switch to a long-term investment then?
Everything was breaking down. That was just it. It was all of a sudden, all those formations that you were hitting that you were looking at, buying high, selling higher, started disappearing. Prices started to break down, and you didn't realize what was happening. So at that time, since there was nothing else to buy, and in terms of my strategy, I just told myself, hey, every day I go to the office, you're opening ridiculous amounts of accounts every single day. The overall performance of your stock is doing really well, I'm putting everything I'm going long-term on this guy already, including margin. So I bought everything at $14 and I watched it go all the way down to 288 at the very bottom.
I see. So it did not occur to you at all just to remain in cash and watch what happens thereafter, but you just really want to make sure your capital is being deployed at any point in time. Was that what went through your mind?
Exactly. And you couldn't, as an individual, I was 20 something years old during that time. You didn't really realize that the whole market can go belly up like it did. Like you have zero experience of seeing that. I saw part-time what the tech bubble looked like, but I didn't imagine that it would be like 6-7 years down, and then you can imagine the whole financial sector and the global financial sector collapse like it did, right? Where you see 100-year-old companies going under. You couldn't imagine that at that time.
Yeah, probably at that point in time, things were not obvious yet, right? When the market starts falling very aggressively. And it was only on the hindsight that you start to realize that the entire economic framework, there was the systematic risk that was existence in the economy was really bad. So was it at that point in time that you started to realize how important studying the market sentiments is? And by the way, when you decided to become a long-term investor in COL at that point in time, did you actually seek your dad's advice on that?
He was the one selling. I was the one buying. That's where the funniest part is, what he allowed me to actually go through all of this, right? And like what I was saying earlier, is that this is part of growing in life. He doesn't really know where that stock is going. He's selling it at this point in time, but he didn't foresee that this thing's going all the way down to 288, right? But for me, he just let me experience the whole thing, which I think was a great learning experience as a whole. I wish I didn't lose that much money, but that's part of trading, right?
So correct me if I'm wrong. He was actually risk managing when he actually slowly exiting some of his positions. But he knew that you were actually getting in to become a long-term investor, but he decides not to share with you his opinion and the reason why he's doing all this, just so that you get to learn it yourself the hard way.
Well, everything's hindsight, right? Somebody who could have came in and bought the stock, so he can't really tell. But yeah, basically what you said, he let me experience it firsthand.
Okay. So can you explain a little bit? So this is the very first time that you are, in a way, facing such a so-called catastrophic trading event that happens to you, and you have never experienced anything like that before. So can you explain or share a bit more about how you felt psychologically, emotionally, as you saw these long-term investments that you feel so loving for, went all the way from that high price to that low price, and you have to encounter margin call and you have to liquidate as a result. How did it all feel for you emotionally?
Basically, that's the trials that everyone's looking for. Everyone has to face this level of adversity. I never believed that you can actually make a lot of money without being able to experience something this significant. Everyone's got to go through it, because you have to realize that if you're taking this level of risk at any point in time, it's inevitable that in order for you to make big money, you have to be able to take some level of risk. It doesn't have to be necessarily be this significant, but it's got to be a significant level of risk in order for you to get that significant level of reward, right? So that's a perspective that actually afterwards was that I told myself was that I would never lose this kind of money ever again. This was something that I will never allow myself to do. So that's a huge learning experience in terms of overall risk management that you're taking, that you can't over leverage yourself at any given point in time, especially for long-term investments, and then leverage in general, how to maximize it, right? Because leverage is important when knowing when to use it, but also understanding that you can't sit long-term on this kind of leverage, right?
Yeah, and of course, timing is very important as well. So after you experience that pretty catastrophic event as a pretty inexperienced trader, what was your evolution thereafter? So you mentioned that one key thing is that you told yourself that you're not going to lose or encounter that kind of drawdown ever. So was it really that very last time that you ever encountered such a drawdown thereafter?
Of course not. Of
Of
course
course
not.
not. Okay. So let's get you to share a bit more. So what was your evolution there after
So
that particular event?
so you're basically going from buy high, sell higher strategy to investing standpoint where you lose your pants, right? And then during that period, there was a stock called Ivanhoe Mines, TRQ. Now it's Turquoise Hill. And basically every single day I'm with a fellow investor that's we're basically lying to ourselves every single day that this is going to be the greatest thing of all time. So you dabble into reversal trading and being able to continuously averaging down on a great story that never materialized. So we were starting buying this at $5, went down to 4, went down to 3, went down to 250 before you start puking it out, right? But the lucky thing is that I wasn't 100% deployed like I was in COL in 2008. I was probably around 50-60% deployed. So I did still lose my pants. The stock dropped about almost 50% before I told myself that I was getting out. But at that time, I also understood that this is the last time I'm doing it. And it was finally the last time I actually lost my pants in any trading environment. So we've dabbled in extended investments already. We've dabbled in reversal trading and trying to get great stories and trying to and losing money on that as well. So that was the last time I lost that significant amount of money. And then afterwards, that was the final straw. And I hope I will never have to go through that again.
Wow, fantastic. So after that first humbling experience, you straight away went for another humbling experience.
Yeah.
By doing the worst things that most traders can do, or even investors, which is to average down, incurring huge opportunity costs, and finally getting out because there was no other choice left. And so what happened thereafter? So you had encountered two humbling experience. What changed thereafter? Did you start to think about coming up with a framework, with a more systematic way of how you trade and invest? Or was it again this kind of hit and run methodology that you continue to use?
Yeah, so the one thing that we did now had to do was that because we were training traders, it was really a focus on being able to create a better framework for the traders to work off of. At first, it was just general technical analysis, and then trying to buy high, sell higher during those periods. And we realize that it doesn't work in every single market environment, right? So we now have to adjust based on what the market environment is going to give us. So whether it's more swing trading, buy low, sell high, or during certain periods where you're looking at heavy neglect and now looking for movers during neglected issues. So what happened was that we had to build some semblance of framework where which is what FTSR, you see this, the FTSR here in the back really is today. So that was probably in 2012 when we first started having to structure all of the experiences that we've had, where we make money, where we lost money, how we made our money. So there were lots of periods where we made a lot of money. And then there were lots of periods where we lost a lot of money during those times. So we basically have to figure out the times we lost money, what are the common denominators, and the times that we made money, and what are the common denominators there. And we want to replicate the times that we're making money, and we're trying to cut away the periods where we're losing money, right? And at the same time, we have to be able to package it so that we can actually teach the traders. Not even for students, we're starting with the traders and having to rebuild them to have that same mindset, right? So that's where the evolution of our trading system really began. So we cut into multiple parts: momentum trading, swing trading, and position trading. And then certain individual traders have their own core competencies, right? Some are better in momentum trading, some are better in position trading. So it now caters on terms of personality. What kind of personality fits the trading system, right? Yeah. So it was the period between 2009 to 2012 was really a lot more. We didn't really lose a lot of money, even if that one circumstance that I lost in Turquoise Hill, it was a fraction of what the bigger funds looks like, right? It wasn't like 2008 2008, where I completely lost my pants. That was a completely different scenario. So during these periods, there were a lot of bursts where we made a lot of money as well. So being able to compile all of that and then finally package it to be able to be given to our traders was really the foundation for us to say, okay, I think we can actually even give this to students outside.
So if you can recall, which year was probably that year or the period where you finally realized that you might be turning the corner, that you are finally emerging yourself from a hit and run kind of a trader / investor to someone who knows what you are doing and you are starting to experience more consistent results? Which year was that, and how did
it was
how
probably
did it feel like?
2010. It was probably 2010. Because 2009 mostly was really picking bottoms. So it wasn't a period where you really have that level of confidence to say, okay, I think I can replicate a lot of the things that I'm doing. A lot of that was still trying to pick up from the ashes of the mistakes that we made in 2008. And then the real turnaround was really 2000. And so we started Caylum in 2014. So, 2013. It was really 2014 where everything started to take off. Because the biggest thing there is that when you have to teach to other individuals, you really have to walk the talk, right? And being able to have to concretize the trading system forces you to have a level of expertise and mastery in what you're doing. So even if before you had a general idea of why it was working and there were great periods of success, it was only during that period where we would have to teach it to other individuals where your performance really takes off. And you really have a sense of mastery on the trading system.
I see. So during that part where you started to realize that things are starting to work out better, was it really all about you learning from experience? Were there any kind of mentors or any experienced traders that you personally felt have guided you along the way to help you accelerate your learning during that 2009 to 2012 period?
There are certain individuals that really helped us through this, but most of those individuals were our former traders. I'm not sure if you're familiar with Juanes Barredo from COL Financial. He was one of the guys who was really coaching the entire trading team before I inherited it in 2008. And he was helping us in terms of the technical analysis portion. But it's very different when you're being taught technical analysis on a theoretical level versus on an application level, where you're directly firsthand trying to push buttons and experience what you're learning from a book or from a mentor and actually implementing it into the trading system as well. Even paper trading versus actual real money trading is completely different, because paper trading just doesn't really have the same level of emotions and commitment that you would have when it's real money, right? So that's one of the things where if people ask me today, do I think that it's important for young individuals to learn the market? Oh, absolutely, but it's got to be real money, right? I want it to be small amounts, but it's got to be real money so that they can actually directly feel how difficult it is to make that kind of money in the markets. So we always say that experience is always the best teacher, right?
Yeah. All right. So for that, based on the experience that you have, if you can just quickly summarize your evolution from someone who knows nothing about trading to being the proficient and profitable trader that you are today, what is, let's say, if of course it is definitely more than three, but if we can just talk about three main things that you felt was the crucial factors that help you transit from a newbie, a trader who doesn't know how to trade to someone who knows how to trade. What are the three key biggest changes you've seen in yourself during those few years?
The first thing is that, and most important, is that you have to be able to learn from experiences. That's number one. If you're just going to lose money and not look back at your trades and not figure out what you're doing wrong, or even what you're doing right, you can't be able to even start building a trading system. You can take another individual's trading system. Let's say I can get any, you can get any of the ones from Caylum, but if it doesn't fit your personality, it's still not going to match, right? So you still have to be able to learn from your own trades themselves. So what's key here is that number one, you have to learn from all of the trades, whether profitable or losing. All of those things you can learn so much from. That's number one. Two is putting that level of commitment in towards improving your craft. A lot of people, when they lose money, they just give up. And like me, I lost my pants in 2008. I could have just said, okay, I just don't want to do this anymore and find something better to do, right? But it's putting that understanding that this is something that I believe in the larger scheme of things. I can really become a professional. I can make a lot of money here. I can use this as my core skill that I can pass on to multitudes of individuals, my children, other individuals as well. So by putting that level of commitment into your work, that's when really you can expand your trading. So that's number two. And number three is really now concretizing a trading system. You learn from your mistakes, put the commitment in, and then now it's being able to say, this is what I want to do. I only want to trade duration formations. That means that if I'm seeing other opportunities, even if I pass, there's no fear of missing out. So, because a lot of times it's really emotion. It's now saying, okay, do I let this go or do I have to participate in it? This isn't my core competency. I should be letting it go. But that's something that until you are able to build a trading system, you can't understand that. So being able to understand what is my A trade, what is my go-to trade. If everything is going wrong, I have to focus on this trades, and I know I can make money moving forward. But yeah, so in those three steps, I'm pretty much looking at.
I see. Wow, fantastic. I think that's going to be something that every traders who are still struggling in their trading right now will probably have to think, try to recall, review, and recap how this could potentially be applied to them. So now, Lawrence, let's move on to the present days right now. I understand that in the year 2018, I'm still going to stick on more towards your trading results, because I understand that in the year 2018, you are actually adopting a more systematic approach towards your trading nowadays. And it seems like your performance in 2018 had a 54.86% kind of returns. All right. And in this, that year, you did about 68 trades. Your hit ratio, which means your winning ratio, is about 33.8%. with an edge ratio of about 5.17. All right, so that's really a very fantastic kind of trading outcome. Would you like to share a bit more about the year 2018? What were the key factors that allow you to generate this kind of returns? Was it a combination of perfect market condition, or was it a result of you making adjustments to your prior trading system in any way?
So actually, I'll start with 2017. The reason why is because 2017, I focused directly on duration formations. That was really my core competency ever since. It's position trading, duration formations. So you're looking at area patterns, you're looking at, so whether it's boxes, wedges, or whatnot, right? And that was what I spent most of 2017 trading. And I did very well during that period. But the thing there was the market was changing late 2017. And the market was showing much more momentum trading strategies moving into 2018. And then right before the crash, in the whole market, especially emerging markets, sold off in 2018, right? And the funny thing is that the duration patterns in 2018 were fairly non-existent. That's because of the heavy volatility that the market was presenting. So the nice thing about when markets are collapsing is that the strongest stocks on the board will emerge all the time. So we always say that when you're looking for the needle in the haystack, it's always easiest to find it when the barn is on fire. So that's basically what was happening. The whole market was collapsing, and the strongest stocks on the board were showing up. So
what do you mean by showing up? Can you explain in a more literal way?
Normally what happens is that if the whole market sells off on a broad base, you're basically seeing everything across the board sell off, right? And then the ones that don't sell off are the strongest stocks on the board. because there's reason why people are purchasing those stocks, right? So for us, it's actually easier for us to be able, on a relative strength basis, it's easier for us to be able to see those issues. Unlike today, where it's even more difficult because the whole market's basically at its all-time previous highs, right? If you look at the US, most of the issues are at the all-time highs, right? It's harder for us to distinguish the fundamentally strong issues during these periods because everything is strong across the board. So how do you know which ones have more upside versus the ones that don't have upside when everything looks the same? It's very difficult. So 2018 was was much easier for us to identify these issues. That's why when everything was falling, the ones that weren't falling are the ones we focused on. And then what we did was we do a lot more of storytelling. So we call it storytelling. So basically, any of the issues that are showing a great earnings performance, we start taking a look at what these companies are doing. So that's basically where we got the outperformance, is because we're able to hold on to these generally small cap issues anywhere from 2 to 5 billion US dollars. And we're focusing on these guys and that are gapping because of earnings when the whole market's in the gutter, right? So relative strength is in place. Great stories, because these are high earnings potential issues that are finally gapping and then showing momentum trades. And the outcome of that was that a lot of these issues during these periods were heading up anywhere from 50 to 200% return. So some of those issues were cloud issues, like Mule, which was M-U-L-E, Mule, which was a API provider. It's what cloud is today, cloud 2.0. So most of these issues alongside Mule were definitely flying. So that was really the biggest winner. So if you look at Mule last year, when we first saw it, on its first gap after neglect, we were looking at this issue. It was 4 billion market cap, and it had the potential to be anywhere from 30 to 40 billion in terms of total addressable market, right? So the thing is, we weren't the only ones looking at it, because CRM eventually acquired it at 9 billion. So, but we did make it all the way to acquisition. So the thing there is that if you're only trading based on fundamentals, you're basically scalping the whole time, and you don't really understand how much upside everything has. But if you're looking at it based on including a fundamental level, which is what we're doing today, you're basically understand which companies you can hold and which companies you have to scalp, right?
I see. And for context purpose, were you looking at just the US market, or were you looking across other markets as well when you were trying to find all these kind of ideas?
Normally, because the lack of liquidity in emerging markets during these periods when you have these sell-offs is detrimental to trading, right? There's no real activity. So basically, we didn't have a choice but to focus on the US, right, at that time.
Okay. So under normal circumstances, you actually look across different markets as well, using the same methodology?
As much as we can. So the nice thing about today, unlike before, is that you have the ability to trade global markets. So we're basically chasing wherever the hot money is really going, right? So today, because of the strength of the dollar, everything is in the US. So you don't have a choice but to focus in the US. But if ever the US dollar starts to weaken, we don't have a choice but to try to figure out where all that money is going all over the world, whether it's emerging markets, whether it's gold, whether it's Japan, whether it's Europe.
So in a way, correct me if I'm wrong, following liquidity is one of the main things that you are constantly trying to understand and find out.
So if you look at FTSR, liquidity essentially is the S, right? It's market sentiment. It's trying to understand the relationship between all of these different pieces, whether it's interest rates or yields or the dollar or inflation and other currencies, and trying to match where all the fund flow is supposed to go. So if you can track where the fund flow essentially is, most of the funds are globally, you probably have a bigger chance of trying to find out where the underlying demand is, right? Because everything's driven by supply and demand. So if there's no demand in a specific market, markets aren't going to go up.
I see, I see. All right, so Lawrence, just hold for a moment. For those of you who are watching into this interview that I'm conducting with Lawrence Lee, before I go on to pose more questions to Lawrence, I would like to take this opportunity to let you know that Lawrence will be speaking at the Global Executive Program 2019 in Singapore, hosted by Caylum Trading Institute, a premier trading education facility that is headquartered in the Philippines. This is going to be a 2-day paid workshop held over the weekend of the 24th to 25th of August. This workshop is going to teach working professionals the art and science of part-time retail trading strategies and workflow. And in this knowledge-packed event, Lawrence will be sharing the stage with Mr. Edward Lee, the founder and chairman of COL Financials, which is the largest and the only public listed online stock brokerage firm in the Philippines. At the same time, Edmund Lee, the president and CEO of Caylum Trading Institute, will also be sharing his trading knowledge during this event. So you can find out more information about this 2-day workshop at traderwave.com/GEP2019. I'm personally attending this workshop to learn and interact with these 3 highly accomplished traders. So you might want to consider joining me as well. All right, great. Lawrence, back to you again. So you mentioned that the liquidity was something pretty important that you guys look at. In fact, the whole FTS, what's the last word?
Risk,
right? Risk management. So this entire framework is actually the cornerstone of how you guys frame your entire trading decisions or investment decisions today. So I would like to just go back a little bit more about your rationale of choosing to go with position trading. Was it something that you realized over time that's a kind of time frame that you personally preferred? Do you also at the same time use things like your momentum strategies and swing trading strategies while you are using this position trading strategy as the main core of your trading framework?
Yeah, because the reason why is because we're still running a business here, right? Other than just trading. So a lot of times I'm actually working with traders on a day-to-day basis instead of actually being in front of a computer and trading. So I had to make an adjustment where I had to be able to trade while at the same time not really having the time to trade. So the reason why position trading is the cornerstone of my trading system is because this is a matter of how I live my life. I believe that I can still get significant outperformance based on position trading. I get to sleep at night. I get to interact and work with other individuals here at the office. And I can make money. So that's how it evolved. But initially, when I was younger and I had much more energy, I still did a lot more momentum trading, right? So that's one of the things that I now have been imparting to my younger traders here in the back is that the momentum trading strategies are always going to be in play. And they have the energy, they have the time to do it, and I want them to focus on it. So I let them doing all the momentum trading, and I'm the one that does more of the position trading.
Wow, that's actually a pretty good insight. In fact, I personally realized the similar situation as well. I mean, when you are still young, you have that energy, you don't have family commitments, and you have that full attention to be placed in the markets. That's when a momentum strategies or even swing strategies might be probably more profitable than position trading because of the frequency of trades that you do. If you are able to maintain your edge ratio and your winning ratio well, that could actually potentially end up being more profitable than position trading. But as time goes by, when you start to become more mature, you have families and you have other things, as considering that you need to run a proprietary firm as well, I suppose position trading really makes a lot more sense for you. So can we discuss a bit more about your position trading strategy? What is the main framework of your strategy that you're using for this position strategy right now?
It's really doing a lot of homework. Like I said, we do a lot of storytelling and we do a lot of homework. That means that you have to have a general watch list of issues that you're tracking over extended periods of time. That means that even if the markets, if the stock falls in the short term, as long as fundamentally things are still good, you still have to track them, right? So it's really building a core list of issues that you're familiar with, that you know the ins and outs of, you know, the underlying potential of these guys, and you know their growth rates and all of these other issues that can affect the stock, and now looking for entry points on them. on the big picture. So normally these are duration formations where prices are parking from anywhere from 4 to 6 weeks or longer. And now they have basis for you to be able to put a level of risk on. So you're purchasing it off the break of the highs of these ranges over these past 4 to 6 weeks. A lot of the things that we're really looking at are issues that are where the underlying demand is very high. So you're talking about issues that are underlying earnings is fantastic. And normally there's enough demand that the whole market wants to participate in these issues, right? So like today, these are anywhere issues that are guys like the Cloud 2.0 individuals, whether this is Okta or whether this is Twilio, and a lot of guys such as semicon guys like AMD, where they're heavily they're disrupting specific sectors, or even the 5G guys like Xilinx. So a good example is like Xilinx, where Xilinx, because of their last earnings, got sold off. Most of the time, if you're looking based on price, if the price sells off, you're scratching it off your watch list, right? What we do is that when these guys sell off, we're actually prioritizing these guys firsthand, because we know eventually that the underlying fundamentals is so good that we want to be able to find entry points eventually. It might take another 6 weeks or 8 weeks, but we're planning ahead of time, right?
So in a way, correct me if I'm wrong. So fundamental is one of the first steps that you guys take so that you know what are that list of issues that could fundamentally be very good stories, and you just wait for the right moments to get into those issues when they start to go into some kind of duration. So can you just elaborate a bit about what you mean by duration and formation? Because I think that's some terms that people who didn't really go through the kind of courses or the seminars that you conduct might not really understand that.
Sure. Normally prices will either be in magnitude or duration. It's only one or the other, right? So magnitude is when prices are trending and moving at extended paces. So that's normally what we like, right? We like to be in a situation where heavy magnitude towards the upside. That's what we want. But in order to find it, we need to be looking for the duration patterns that are in between. So if you look at prices, they move normally in some semblance of a step ladder formation. So it's magnitude into duration, magnitude into duration. So duration can be sideways or can be a downward price movement. So if we wanted prices going up, ideally, any downward price movement is a form of duration. And any sideways pattern is a form of duration. And these duration patterns normally will probably trade anywhere from 6 weeks to a few months if prices are going into extended durations, right? So that's essentially what we're looking for. We're looking for prices to stay at a agreed upon supply and demand level for an extended period. And then now we're looking to see whether or not the next round of earnings can push the prices higher.
I see. So typically, I mean, in really solid bullish market conditions in the broad market, strong issues with good fundamentals usually just keep on going higher and higher. Very seldom they will actually see a duration where it gives you the opportunity to try to load up or to even get in the first place. How do you reconcile with that? Or do you consider chasing in if you find that this is a fundamentally a good issue and you just don't see any duration, but still you decide to get in? How do you reconcile that?
Right. So we also understand how to trade in momentum as well, right? So if these are really fundamentally strong issues, that's still the heaviest priority. So if these guys are now trending, we have to just now, but the thing here is that we can't bet a lot as much during these momentum trading environments, right? So most of the time, the big money is really made either during reversals or during these duration patterns. It's not, you can't bet a lot of money during the trending environments, right? So we just spend our time, we still participate on the momentum trades, but we just can't bet as much.
I see. So this is probably when patience comes into the picture and it's really crucial. If you miss the boat, you just simply got to wait or look for some others that you have not missed the boat yet. Is that right?
Correct. That's right. But this is where our research team is very important, right? We rely heavily on our research team to continue to generate new trading ideas, new stories for us on a constant basis, because there's always going to be new stories that come around, especially during every earnings season. There's always that one company that blows out earnings and then that your eyes have to now focus on, right?
All right. So you, based on your last year of trading, you had 68 trades done. Your hit ratio was about 33%, which means only about 33% of them actually made you money, which means that 66% actually lost you money, and you probably got out at a stop loss. So is having a strict stop loss something that you guys enforce very strictly? And can you explain a bit more about this, the hit ratio that you had for the past year? How was the circumstances like?
When you're looking at those numbers, in actuality, out of the 68 trades, I actually made all of my money in 6 trades.
That's about 10% of the trades.
I made all that 50% on 6 trades. The rest of the trades that happened were basically offsetting. So you're basically, the small wins are offsetting the small losses. And remember, I told you that I don't allow myself to take a loss. It's because my losses are actually standardized. I have a maximum loss that I allow myself to take, right? So I don't allow myself to take more than that loss, because the moment that I know that the current position is losing almost that level, I have to now be prepared to take money off the table, right? So I have to cut those losses, and I'm not afraid of missing out on opportunities, because I know that there are going to be opportunities that are going to emerge every single day. So if you look at those numbers, it's 33% hit ratio, but it's actually the 10% that made that money, right? The other 20% of so out of 68 trades, 6 trades made money. The other 15 trades that made money are offsetting the other, how many issues? 40 issues that lost money. So
I see.
That's basically what it is. So the small wins are offsetting the small losses. So if you look at my edge ratio, it's actually over 5. That means that every time I lose money, I lose $1. Every time I make money, I make $5.
Yes, that's right. So, well, if that's the case, okay, 33% hit ratio. So, do you also use the similar methodology like what Edmund advocates about the value at risk, like a 1% value at risk per trade? So for yourself, what kind of percentage range do you look at? Do you vary it depending on the ideas, or you apply a standard percentage regardless what kind of trades you take?
It's actually more based around what our A trade is. So most of the A trades, we always put 1% risk. If it's a B trade, so of course, depending on the criteria, right, that falls under the A trade. So me, these story-based duration trades are my A trades. And then the B trades are those momentum trades that we were saying earlier, where prices, good fundamental issues, but prices are jumping too fast. Those are basically your B trades, right? So we're putting more risk on the A trades, and then the B trades, we're dropping our exposure on that. So normally it's a 0.5 VAR on the B trades and then 1% VAR on the A trades.
I see. Wow. That's a pretty good insight. How do you generally determine where to have your stop loss, where you will cut before? Of course, you definitely does position sizing as well based on the 1% VAR. So do you place, so decide your stop loss? Sorry? You losing?
So normally, if you're talking about duration formations, the stop loss that we put to size for our position size is all the way at the bottom of the range. So the top of the range is the purchase price. The bottom of the range is where we measure, right? So that total area from the top to the bottom is equivalent to your 1% VAR.
I see.
But normally what happens is that, especially if prices are breaking out from the resistance and they start coming back in, normally there's a range somewhere where we normally have an idea of where we should be cutting beforehand. So we never really take the full 1% damage. We're taking normally anywhere from 0.4 to 0.6% damage.
Okay, so 1% is probably the worst case scenario, where
in the event like all hell breaks loose.
Yeah, or things like, I mean, were there occasions where it gapped down more than the stop loss level that you were looking at and you incur more than a 1%
It
kind
can
of loss?
happen. It can happen. It can happen. But here's the thing. Those situations normally are black swan issues, right?
Yeah.
That means that you can't trade around black swan. If you're going to go into trading and trade because of and be afraid to trade because of black swans, you might as well not trade in the first place, right? But there are those black swans, quote unquote, black swans that you can avoid. So if you know earnings is coming and you know that there's a possibility that you're going to get a black swan, you're basically asking for it, right? So there are those black swans that you can avoid. Fda approvals is another one that you have to be looking at closely. If you know there's an FDA approval coming up, you generally don't want to be in that stock, right?
Yeah, that's right. That's right. So in any case, your 1% or 0.5% is the one that will prevent you from having any kind of catastrophic drawdowns in the first place. Because if you maintain it at 1% or less, even with a gap down, it shouldn't cause you to incur more than a 2% or maybe even 3% kind of loss on that particular trade. And as long as you diversify well, I think generally that's going to be okay. So let's quickly discuss a bit about your profit-taking strategies, because stop loss and entry, that's just one aspect of it. What is the general kind of profit-taking strategies that you prefer to look at most of the time?
So normally when we get anywhere from what we call 2R, 2R is basically our purchase price to the risk, right? If we're getting 2R, we have to at least take half of the position off the table. That means that there's no question we have to sell half. If we're already past 2R and we haven't sold half yet, it means that we're in a greedy mode already, right?
Yeah,
and it's inevitable that, especially if we like the company and we've done a lot of homework on it, we can get extremely greedy, right? But it's really that other half, the balance, that allows us to be able to take advantage of what we've worked hard for. And what I mean by that is that because that balance, what we call a kicker, if that thing is wrong and it goes back to your purchase price, basically you're not making any money on it, right? But at least we've taken half off the table. And if we've taken half off the table, that makes sure that the trade is always profitable. That's one. Two, the other side of the coin is that if the kicker continues to go, then we can really try to trail as much as we can. And sometimes those issues can go, if you're picking great fundamentally stocks, these guys can go anywhere from 50 to 200, 300% more than where you purchased it from. And that's what allows us to get that outperformance. At the same time, we already took all the risk off the table because we sold half on the issue already.
Yeah, because I mean, if we look at having an edge ratio of about 5, and if you have even your best trades, you get out half at just 2R, which means that some of those trailing stops could potentially end up giving you at least 7 to 10R kind of returns in order to get an average 5R
That's what happens.
edge ratio, right?
That's what happens.
Okay. So it's really the minority of the trades that generates the bulk of the returns for you guys. So
it should be.
Do you consider yourself really as a systematic trader, or do you think that discretion is actually still a big part of what you do on a daily basis as a trader?
No. Today, I'm incredibly systematic. I joke that at night before when I say that I have to watch the U.S. market, I'm basically glued onto the computer screen. If you're glued onto the computer screen, it means that the level of discretion required and the temptation of discretion is very high, because you have to watch on such a constant basis. If you're a systematic trader, you can just rely on your stops, right? You don't actually have to watch the market too much. So what happens now is my wife jokes that, are you even working at night anymore? Because everything is stops, right? It means that I'm so comfortable with my trading that I actually can't sleep at night. And I have my stops to protect me if prices go wrong. So all I have to do is really watch the first hour of the market every single night, unlike before where I don't sleep till like 3, 4 in the morning.
I see. So what you mean by systematic is actually once you get into a trade, the monitoring of the trade itself is actually fully systematic. But I would suppose that the part where you need to decide what issues to get into, whether it's the right time to get into right now, these are still pretty much discretionary process, right? While you're doing the research, or is it still a purely systematic?
It's still generally systematic. The only discretionary portion is really the stock selection, right? So that's because not every single stock has the same criteria, right? But actually on a technical analysis level, that's also very systematic. It means that we already know the kind of trading formations that we like. So whether these are wedges, whether these are boxes, those are things that you can easily find, and the criteria there is easily seen. So knowing all of those and knowing where to put your stops beforehand, all of these things before we enter the purchase button, we can already be able to detail these things down. So there's no real level of discretion on where there's no compromise in terms of those issues. Those are non-negotiables, right? The only thing that has a level of discretion is really the fundamentals, because sometimes not all the fundamental criteria is the same.
I see. All right. So you see, right now is that generally the markets anywhere is pretty bullish right now, except for, of course, my native country, Singapore, which is still not looking so ideal yet. But we are again in a phase where it's bull markets everywhere. So how are you preparing yourself from the inevitable day that will come where the significant market turnaround of things like 40%, 50% pullback or bear market could potentially come? And how do you plan to navigate those kind of situations? Do you have any plans to look at shorting the market, or are you looking more towards just staying out of the market? What kind of preparation have you thought about when situations like that arise?
Okay, so if you look at the market today, you're talking about a market's at new highs, but it's not a strong bull market. That means is that you're seeing prices go up, but they're creeping higher, not going up vertically, which means that those people who are participating in the market it's not easy for them to make money in the markets, because it's not like the markets are going up significantly in a short period of time. It's like every day you're getting like 0.1, 0.2% higher. So because of the creep, what happens is that a lot of individuals, the patience level on these guys is very low. So what I'm seeing today is that this is where market sentiment comes in, is because a lot of what we call quote unquote smart money is actually out of the market. That means that if you're looking at it on that standpoint, that's one. And then two, the Fed, the US Fed actually has room to rate cut. That means that if they are going to cut rates at these periods in time, there's actually liquidity that will be heavily injected into the markets. So that's two. And three, and this one's a very interesting one, is because there is actually no significant leverage, unlike 2008. So like 2008, the amount of leverage in the market was ridiculous, right? Even when you talk about subprime, it's basically those people taking the notes of the mortgages of the subprime and then repackaging it and then selling it again. So the amount of leverage that was happening in 2008 was ridiculous, and that's not present today. You have to remember that in order for prices to drop like 2008, you need to have prices that will go into euphoria beforehand. And we don't see that today. Unlike 2008, if you look at China, where China was essentially 90 times PE, the amount of euphoria that was present in 2008 was that significant. And that's not present today anywhere in the world. Even Bitcoin's fallen already. So that means that if you're talking about downside today, the downside I don't think is as significant as that of 2008. You might see some short-term sell-offs, but if those prices do sell off into value levels, the smart money is there to purchase the shares. So there's actually people on the side that can purchase the shares. That's one. Two, the Fed can cut interest rates, which means that you can inject more liquidity in the markets. That means that the downside is also generally not too significant. And thirdly, if there's no leverage in the market today, that means that people don't really have any urgency to liquidate, because margin calls won't be in place. And even if they increase interest rates, it's not that as painful, right? So I don't think that the downside that people are seeing is the same downside as 2002 or even especially 2008. So if you're asking my opinion on the markets today, I'm actually not too heavily deployed today. I'm generally pretty light today because I know that the upside is capped, but my wallet is definitely open if the prices do sell off. I'm the shorting maybe. I don't think I'm heavily going to be shorting, maybe jabbed here and there just to feel the markets. But I'm not going to be in a position where I think that I'm going to be heavily deploying on the short side because of what I'm seeing in terms of the bigger picture on the market sentiment level.
I see, I see. Great, great, fantastic. So that's some really good insights as well. So finally, Lawrence, I would like to discuss or have a little bit chat with you more about your experience running a proprietary trading firm. So you guys, you have 40 proprietary traders under your guidance at this moment right now. So I'm sure there's quite a number of our audience watching this interview who are actually potentially thinking about becoming full-time career traders, whether it's working for proprietary trading firms or working in a hedge funds or maybe just trading for themselves. So in your personal opinion, what do you think is the biggest difference between a part-time profitable trader versus a full-time proprietary trader, and how should they reconcile and connect these two together or to separate them?
All right. The joke we always have is that if you want to be a full-time trader, don't do it.
Why?
Okay, right. The reason why we joke about that all the time is because if you have to trade to put food on the table, you will not be able to survive this. You won't be able to survive this. What that means is that you have to be able. There are going to be times where it's going to be famine. Like most of last year was generally famine, right? If my traders don't have a salary, they're going to struggle, right? And so if you're a beginner, it will take time for you to have the level of experience that's necessary in order to be able to navigate through the difficult markets. If you've never seen difficult markets before, and then it's your first time as a beginner and having to try to make money to put food on the table to get through it, you're going to have a difficult time. So that's why we joke around about not doing it. And the reason why, another factor that we always encourage people to do is that if you have a specific specialty, example, you're a business owner or you're an architect or whatever it is, you can still make money in the markets as a form of passive income. So it doesn't mean that just because you are a part-time trader doesn't mean that you still can't make money in the markets, right? So like I was saying, you talk about me, you reference me as a trader, but in actuality, I'm also running a business. And most of my time is running a business instead of actually trading. And I can still create some level of outperformance because I build my trading strategy around my lifestyle. So that's something that I want to make sure that everybody's clear about first, right? The second thing is that if you want to do this as a full-time trader, and this is something that you realize, is that the markets are incredibly cyclical. And this is fact. It's not going to be rosy every single day of the year. But when times are rosy, you'll make a lot of money. And when times are struggling, if you don't have the experience to navigate it, it's going to get difficult. Right? But if you do have the experience to navigate through difficult markets, you'll also make money. So that's the thing that we have to understand, that the level of commitment that you need to have in this industry is very high.
So what?
I guess I spoke about it in terms of the 3 tips that you asked me.
Yes. So what do you think are the main motivations of why those proprietary traders are willing to do it on a full-time basis in your firm? Was it because they feel really passionate about the markets that they don't think they want to do anything else that is not related to the market? Was it for the money, or was it really just the kind of lifestyle that they wish to have? What do you think are generally the main motivations?
The biggest thing that realization that I had after working with 40 traders is that by being a trader, you are basically your own boss, right? You're in control of the decisions that you're going to be making on a day-to-day basis. You're in a position where even if there's a level of accountability from other individuals, you're still in control of your own destiny. Unlike going corporate where you're working under a boss, that's out of your control, right? Here, it's, if I want to be good in this industry, it's up to me. And all of that is based on what I'm capable of doing. And if I'm going to work harder, I'm going to spend more time doing it. If I'm going to be more passionate and read more and learn more about my own trading, I'm going to directly improve better, improve more. So what we relate this to is like being a professional athlete, right? We're essentially professional athletes here, even if we are not physically an athlete. What that means is that if you look at professional athletes, some of them 17, 18 years old can play professionally already. And it's up to them to be able to put the time and the effort and the things that go on behind the scenes in order for them to be able to be the best version of they can when they get onto the playing court, right? So the same thing with us. It's the time that you spend behind when markets are closed. It's the times that you spend reviewing and researching and learning that's not in the market. Because when you're trading the market and when the markets are open, you're actually not learning anything. You're just executing everything that you're doing off hours.
And plan for.
Exactly. So we always say, plan your trade, then you have to trade your plan, right? Most of what you really need to do is the plan your trade, not trade your plan portion. The trade your plan portion is just protocol.
I see. So how do you go about selecting the right kind of people to join your firm as a proprietary trader? I understand that, in fact, I think that the Caylum Trading Institute is a really good place to generate a business while training potential traders, while you use it as a fertile ground to find the right traders to bring on board into the proprietary trading firm. So how do you go about selecting the traders to decide to bring them on board?
Okay, well, there's two different things that I have to be clear. Just because we don't select these individuals onto the floor doesn't mean that they're going to turn out to be bad traders. I know so many of our students that we don't bring on board that become fantastic traders down, whether it's individually or elsewhere in other brokerage firms. So I have to make that clear beforehand. Because the reason why the guys that we select onto the team from Caylum, our number one criteria is culture fit. That means that just because you're good at trading today, but you don't fit the overall culture of our organization, it won't necessarily mean that we're going to bring you on board. So that's one, right? Two, it's really a maturity issue. Most of the time, that's our number one priority, is whether or not because you have to remember, Philip, this is like the level of authority that we give to a trader is very high. That means that we're basically giving you a lot of leeway to make decisions on our funds. That means that we have to make sure that the individual is trustworthy. It means that the individual is mature and responsible enough to say that if I'm asking you to handle my funds, you're not going to just toy around with it, or you're just not going to lose it irresponsibly, right? So maturity and responsibility are key factors in us being able to select an individual and bring them on board. The third one is really core value system. You notice that none of this really, I haven't even touched about the trading capability yet of an individual, right? Because the value system of an individual will dictate whether or not they're willing to stick with you during the difficult times. And like I said, the markets are incredibly cyclical, and we are investing a lot of time and resources on these individuals. That means that if you're going to be joining us and your value systems are compromised, we'll work with you for a year or two, and then you'll just say, okay, I'm just going to go, right? And time is an incredible resource that we are giving these individuals, right? We can use this time to make money in the markets, whereas we're using this time to develop traders. So this is something that, these are other criteria that is not even has to do with the trader's capability yet. So those are the primary things that we're looking for before we even go into, can this person trade, because we know that basic what we teach at Caylum is really from the ground up, right? So these are foundational issues. So whether or not you have a general understanding of the fundamental reasons why we're why we would like to select specific stocks, whether or not you can see the pattern recognition that we teach in terms of technical analysis, whether or not you even follow the risk management protocols that we put into place. And the one thing that we're really looking for is really whether or not that individual can execute orders. You can make stock selections and you can make theoretical assumptions, but unless you can pull the trigger on making those trades, that's something that is the hardest to teach. So we need to make sure that the individuals we're bringing on board have the ability to execute those orders. Because we have guys that we brought on board before and then they just watch. Okay, we have this idea of what we want to do and we can see it, but when the time comes you have to enter that order, they're frozen. We can't have that, right? We want guys that can push that button and then you can make that order execution, and regardless of whether you make money or not, that doesn't matter anymore. It's now, okay, am I learning from the mistakes that I'm making? Am I being able to replicate the things I'm doing right?
I see. Wow, fantastic. So, all right, Lawrence, I think it has been a fantastic session that I have with you. I wish I can spend more time asking you more questions. Maybe we can reserve it for another occasions. So, sure. But before we end today's interview, would you have any 3 final advice for those let's say new traders out there who's just starting to get into the journey and they really want to train themselves to become a proficient and profitable trader? What's the 3 biggest advice you would have for them in order to get them started on the right footing?
Number 1 is execute. You always start with, you don't know what you don't know. That means that until the point in time where you are actually firsthand applying what you're learning, it's useless. Everything is just hindsight. So what I recommend is, I need you guys, if you want to be good in this industry, you have to enter those orders and learn from the mistakes, learn from the times that you're making money. So that's 1. 2 is that you have to be able to do your review. That means that you go back and try to connect the dots on the issues that you're doing right, and you try to figure out the common denominators, what you're doing wrong. Because if you're not going to do that review, a lot of people they just trade and then it's what we call resulting. It's okay, if I made money, that's a good trade. If I lost money, that's a bad trade. It doesn't work like that. If you didn't follow your process, but you can sometimes make money, that's a fluke. You can't replicate it. If you're losing money, and then there are times you're losing money, but it's part of the system. It's part of the process. As long as you're following your process, you're doing something right. So the last thing that I have to encourage individuals is that you have to be able to build a trading system. Carry yourself to that higher standard. Understand that I'm not going to compromise my standards just to make a trade, or do I think that I can just make money on the fly? No, it doesn't work like that. I have a specific trader that went at a 5% hit ratio for the month. Not 5%. 1 in 30 trades. So 3% hit ratio for the month. He made 1 winning trade for the month, but he was ahead by 12% for the month.
Wow.
Okay, so this individual was up 12% for the month with only 1 winning trade. So if you look at it from afar, you think, okay, this guy's doing great. But in actuality, he just got lucky. So he made money on a trade that went to the moon, but he'll never be able to replicate. And then all 29 other trades were losing money. So it means that his trading system is flawed. It's just that he got lucky. But if you look at it from afar, wow, this guy's up by 12% for the month. This guy's doing something right. So it's something that you have to understand, that just because you're making money doesn't mean that it's something you can replicate. So you have to go back and say, can I still find this level of criteria again? So you have to build a trading system.
Fantastic advice. All right, Lawrence, thanks so much again for joining me in this interview.
Great. Thanks for having me. I had a good time.
Great. So before we end today's trading conversation, for those of you who are watching into this interview, I'd like to remind you again that Lawrence will be sharing his vast trading knowledge at the Global Executive Program 2019 in Singapore over the weekend of the 24th to 25th of August. So if you are keen to learn from Lawrence on how to profit from the financial markets as a part-time trader while keeping your day job as a working professional, just like what Lawrence advised, remember, head to traderwave.com/GEP2019 and find out how to participate in this paid workshop. That's it for now, my friends. I'm your host, Philip Teo, and I hope to have you joining us again in the next episode of Trading Conversations.